Good morning, everyone, and thanks so much for joining us. We have an esteemed and very thoughtful panel of European venture capitalists this morning, and we're going to have a great discussion. And first, just because the VC market can be a bit opaque at times, I want to do a bit of unscientific polling, if you will. So we ran a Twitter live poll in advance of this panel to get a sense of how are people gauging the current slowdown in VC. So you can see I guess the leaders are a bit split, waiting until mid-2023 to the end of 2023 for the VC down market to last. So again, unscientific, but tells you people are expecting the current trend to continue. And then we're also going to run a live poll, as Brad demonstrated. So if you can all scan your QR codes, I guess, and if we can get it up on the screen. Again, just to kind of gauge, I guess, the gap between the US and Europe to set the scene for our discussion. So how far behind does the European VC ecosystem lag the US? Would you say there's no gap? Would you say it's a 1 to 5 years gap? Would you say it'll take more than 5 years for Europe to catch up to the US? And we should get some results. Okay, so the US is in sight. So 2/3 of people saying 1 to 5 years. Sounds about right. Great, all right, well, thank you all very much. And now I want to turn to our panelists. And I think the first question, again, just to kind of set the scene, if you could all just talk a bit, maybe starting with Tom and then going down the line. How has your investment activity changed this year compared to last year, and why?
I mean, I'd love to say that we are consistent year after year and nothing changes, but that would be very far from the truth. In reality, our dollars deployed this year is running significantly below last year, but even significantly below our our lifetime average. We're about 12 years old as a firm, and we're way below the average. There are a couple of drivers of that. Of course, we are at the end of the day, driven a little bit by the spirit of an industry and the spirit of our own performance and our portfolio's performance and our company's performance. And anybody who sort of denies that it's got anything to do with how you feel in the morning when you wake up is full of BS in my view. So there's of course a sort of an emotional aspect to this, but there's also a kind of a technical part to this, which is so many companies in our ecosystem raised 2, even 3 times last year, and the deal sizes last year were way larger than normal. They were anything within 30 to 80% larger than the normal deal size. Therefore, companies are quite flush with cash actually leaving last year. So most companies, and particularly most good companies that we all want to be investing in, didn't need to raise this year. And so when you look at the statistics, there's actually very few deals in market, let alone getting done. And so I would say our deal pace is significantly lower, driven by this emotional aspect, of course, but primarily by just the amount of deals in the market. There's just not many, because most companies are trying to avoid raising this year if they possibly can, which is a mistake in my view, in the hope that next year is better than this year, and that they will therefore raise next year, which is a pretty significant mistake, I think.
Yeah, maybe to give some context, so Lightspeed is a fund that invests across stages. So we invest from seed, super early, founding team just starting, up to pre-IPO growth stage, essentially. And I think you see quite a difference between the two teams in the different funds in terms of pace right now. Early stage is still quite active on our end, and I think especially sort of seed deals, Series A has been very slow, but seed deals have been happening. Mostly because founders are still going out, especially the ones that are really, really have high conviction in what they want to build, despite a recession looming, despite what they see in the market. And actually that's very exciting, because the founders that come in the market now, they are really behind what they're building, and they're usually really, really high quality. On the growth side, however, it's exactly what Tom said, basically. It's very hard to find companies right now that are best in class and that want to raise in this environment, because they usually have a lot of cash already. And then secondly, it's really hard to price. we really struggle to sort of readjust to the public market expectations of the founders, what we think is the right point. It's been a bit of calibration as well over the last months. And I think that hopefully by possibly end of the year, start of next year, we'll get a bit closer to that point where we can have those conversations. But it's been quite slow on the late stage as well for us.
Well, clearly we are in a recession, and a recession affects every sector in the economy, including venture capital. Having said that, at Amadeus, we're a deep tech investor, and we're probably least affected by that because deep tech is much longer term, and there are a few encouraging long-term signs. Having been in this industry for some time, I've seen 4 of these cycles, and the story is always the same. First of all, people have to concentrate on cash, and as Tom already said, many of the companies have been very fortunate to raise quite a bit of money during this fantastic cycle that we've just been through. The second thing to note is, for the first time in history, European venture capital is giving better returns than US venture capital, which is, again, a good long-term sign. But then there is also the correlation that, of course, investors have known for a long time in this space, that if you invest in a venture fund, a new venture fund during a recession, there is actually a great correlation between the vintage year in a recession and the positive return that you can get. And the same thing is true for venture investors, venture companies themselves. So a recession is actually a very good time to start a new company for, in a way, obvious reasons. You have got access to a lot of talent because during a recession there are more highly qualified people available, and for venture capitalists, of course, the valuations are more reasonable during a recession. So this is not necessarily a bad period for venture capital.
Yeah, I think our conversation is coming at a very interesting time because already this year it was quite an uncertain macro outlook, and then the last week has brought even more rattles in the market and changes, especially here in the UK. And so maybe we can I guess reverse the order and starting with you, Hermann. How are you I guess viewing the macro outlook, and what are you advising the entrepreneurs that you work with in the current storms?
Well, the macro outlook clearly is that we're in a recession, and the recession will probably last, a year or two. It's very difficult to predict at the moment because there are so many imponderables that bear on the development. The UK in particular is in this very stormy period of having a financially undereducated chancellor who goes by neoliberal ideology rather than rational decision-making. So that doesn't help. But sooner or later, he'll probably do a U-turn and come to his senses again. When you look at Europe as a whole, the way I see the situation is that if you look at European tech, if Silicon Valley is there, the UK is here, Europe is here, and my native Austria is there, then the gradient used to be very steep. The order is still the same, but the gradient is much shallower. I think a lot of the environment in the UK is now closer to Silicon Valley. But don't underestimate Europe either. Europe is often treated as the sort of lumbering consensus giant. But we've got very vibrant tech communities in Berlin, in Munich, in Paris, in Helsinki. So Europe is snapping on the heels of UK as the leading venture company, as indeed many people, partially because of Brexit, especially at our universities here in Britain, are leaving and going back to Europe. So the fact that the order is still the same, but the gradient is much shallower, can also be proven by Austria. Even Austria, my native Austria, and I run a summer school there, I've been trying to help Austria catch up with the rest of Europe. Even Austria has 3 unicorns now, so it's even trickling down to the very east of Europe.
Actually, Hermann made an interesting point at the beginning about not being sure how long the recession will last, and I think that's an important point that we've been telling founders a lot. So I think there's an interesting game that you need to play. On one side, you don't want to slow yourself too much down, so once the opportunity comes back up, you haven't completely depleted your go-to-market team, your product development and whatnot, and you kind of don't have the chance to catch up again and ride basically the next wave of upswing again. But on the other hand, I think it's really important for especially young founders, first-time founders that haven't been through a recession yet. We often see them thinking that this is going to last until maybe end of this year, maybe mid next year, and then it's going to be fine again. No one knows really. And so I think preparing yourself to make cuts that could be potentially deeper than anticipated, I think is also mentally something that is important. And so I think what we're trying to do is also connecting those founders with founders who've been through this cycle before, who've done this before. It's a challenging time mentally and emotionally, right? And so sometimes it's also better to prepare yourself a little bit more drastically right now versus making 1,000 cuts over a few years, basically, which is going to be more dramatic, I think, to culture, to the company as a whole. So I think just anticipating that this might last longer than we expect initially is I think what we keep on telling the founders.
Yeah. To be honest, I'm also trying to say that let's not focus on the macro at all. To a certain extent, albeit that is a very simple statement to make, we invest globally with a large portion of our capital deployed into places like Brazil, Colombia, Mexico, India, Indonesia over time. And for some of these countries, they were in incredibly difficult and continually difficult macro conditions whilst US, Europe, et cetera, were booming. And yet great companies got built there. One of our portfolio companies called Nubank was built in Brazil at a time from when we invested till now where the currency depreciated by roughly 80%. And yet they built hopefully a $50 to $100 billion company, I think trading today at more like 25 billion. But if you think about that company, macro was completely against them, but to a certain extent, they exploited that. They exploited the fact that the existing incumbent banks were not investing in their branches, were not investing in their product, were not investing in their customers. They exploited the fact that there weren't sort of great jobs for people emerging from STEM education in Brazil, and they took those resources, i.e. the opportunity within their category within banking, and the resource of talent, and they built a fantastic company in a very lean way, a very low capital intensity way, which in banking is not easy to do. So actually what we're trying to say to our founders is, think about what builds a great company. There's basically 3 buckets of resources. There's the idea, and within idea you need drive and motivation. We all have ideas, but actually following through on them is a big part. So the idea and drive and motivation. There's capital, and there's talent, the people to go and help you build this thing. The first one, as Julie actually mentioned, there's always lots of ideas, and generally speaking, there's great people with motivation to go after them. On average, there's 12,000 to 13,000 seed deals per year, globally. 12,000 to 13,000. And that doesn't really vary that much. This year will be lower, but it doesn't really change very much. If you look back over like 10 years of history, it's relatively consistent because people with ideas, people with motivation are there. What changed in the last few years is this amount of capital. So this resource bucket of capital changed dramatically, but at the expense of too many of the ideas getting funded for too long, when instead those great people should have recycled back into the industry with better ideas, and at the expense of the talent bucket, because the talent was getting spread like very thin jam across the entire industry, and being incentivized to switch, to keep hopping. Like all of us will have our statistics within our companies. Employee retention collapsed over the last few years because it was very hard if you were earning X and Google comes along and says, oh, here's 5X. And 5X sounds crazy, but that is the statistic at one stage in 2020-21. Google and Facebook were approaching employees of our companies at 5 times the salary. Even for people who are very dedicated to a cause, a 5 times salary bump is not easy to say no to. So when we talk to our founders, to cut it short, ideas are great and always there. Capital is needed, but actually talent is the most important thing. And this adage that comes out of Silicon Valley of many years of do more with less is sort of a bit of a synopsis or a simplification of talent can overcome lack of capital. And so we're actually super excited about this time frame because we think the best companies will rise to the top. They will be able to get the best talent, and then eventually capital will flow to them. There's loads of money around. It just needs to find those best companies. And so we're actually, to be honest, quite thrilled with the kind of the current state of the VC market. It's much healthier now than it was 1 year ago, far healthier.
I think Hermann had a point you were hoping to.
Yes, I wanted to make some comment on these American monopolies, the GAFA, Google, Amazon, Facebook, and Apple, just scooping up the talent and sometimes also scooping up the companies in areas that aren't even core to their main mission anymore. So I'm just writing a book on technology sovereignty of how these dependencies that Europe is beginning to suffer from just because of American monopolies and the sheer financial power that they have, so that they can pay 5 times the salary if they really want to build up AI capability, or now in quantum computing, where I spend a lot. I've made 7 investments in quantum computing. If I look at who finances quantum computers at the moment, it's in the US, we've got 2 or 3 companies that have now raised over $500 million. PsiQuantum, which we're also a small investor in, Ionic, both have raised 700 and 600 million. We have great government support in Europe for these companies. We've got 2 billion in Germany, 2 billion in France, 1 billion flagship project. But as Tom said, we do not have a startup problem in Europe. We actually produce more startups in Europe than the US. We have a scale-up problem. When we have really good ideas and the companies show that the new product, that the new idea does actually work, we don't have the financial firepower to then put hundreds of millions behind this company to make it a global leader. So that's, I think, our main problem that we have in Europe.
Yeah. I mean, one point I want to follow up, Tom, you said something very interesting earlier about it being a mistake to hold off on raising this year in the hopes that things will turn around a bit. And one of the issues that I've heard about from other investors is like the idea of the bid-ask spread still being too wide. Founders have this expectation that they can raise money at a valuation last year when the market has changed a lot this year. So I'm curious, how is that, are you seeing that spread narrowing at all? And one of the audience members has asked, if VC debt might be part of the answer this year for companies that need funding as markets cool. So are you seeing that spread narrowing, and is debt more part of the answer this year?
I think it's still quite a mixed picture, actually. So I still see both happening. There's been, over the last few weeks, actually still rounds happening at multiples that were more last year, so 50x, 100x current ARR. So some of the best founders and best assets out there still can do that. However, on the other side, I'm also seeing companies now going into flat rounds, actually, to beef up the balance sheet. We see more convertibles happening that kind of defer the pricing conversation a little bit, but add a little bit of cash as well. So I do think structure is coming as well, more and more. I've not seen any of that the last 2 years, actually, and we've seen it in a few rounds now, especially later stage. So I think there's definitely some interesting stuff happening there. And I do think it still takes a little bit of time to reset. But I think founders are being more open now to having that conversation and seeing what makes sense. But it's still on both ends. So it's not, I think, one unified picture at this point.
Yeah, I'd say that the answer is no. I think there's still a lot of naive thinking about where companies are at. And it's not helped by the shareholders of companies, and I'm sure people would accuse us of the same thing, thinking that their own companies are amazing. in reality, we could all sit here and really think back over the last 20 years, how many phenomenal billion-dollar companies have been created. And by billion-dollar companies, I mean viably billion-dollar, with 50 million plus of profitability at some point in the near future. There's actually not that many. And that's kind of makes sense, right? It shouldn't be that easy to produce billion-dollar companies, right? This is hard to do. Produce a company that customers want to pay you for your services, whether it be a software service, whether it be for a computing service, whether it be for the delivery of goods, for the delivery of food, for financial services. It is not easy to build a billion-dollar company. Yet, if you look at this kind of silly moniker of the unicorn, I mean, it was like the last 5 years, it was like unicorns were just being bred as if they weren't special. But when I read my sons and daughters, books at home, unicorns are these mythical, special things. They don't seem very special with the hundreds of them being printed right now. But to be honest, that's all BS. They're not real. A company is real when it has a viable technology that nobody else has, and/or viable profits that are defensible that nobody else has. And most of the companies, just very bluntly in the VC ecosystem, are not in either of those two camps. And so there will be thousands of companies, thousands, that need to go out of business between now and the end of 2023. And everybody's going to be shocked about that and appalled by that, and there'll be weeping and gnashing, and all the great blogs and publications will write about this. But this is perfectly normal. This is what the system's supposed to be. It's a very fat bottom of the pyramid, 13,000 seed deals a year, feeding up through. The companies make it or don't make it. When they don't make it, sometimes they've actually got a great technology, but they can't fix go-to-market, so they get bought by somebody else, or they merge with somebody else. Or the idea didn't work, but the team is fantastic. They cycle back into the industry. And this fat bottom of the pyramid gets to the very top, small of the pyramid. Whether it should be a couple of trillion-dollar companies, who knows, that maybe isn't that healthy either. But realistically, the majority of ideas don't make it to the top. And we just have not seen that for the last few years, because almost every company could raise capital for the last 3 years. Almost without fail. Didn't really matter if your idea was amazing, not amazing, traction, not traction. It's 10 other companies in your space, 100 other companies in your space. That will change. And until that changes, it also means that people are going to hold on to their companies. You see a lot of convertibles, a lot of internal rounds being done. A lot of like, oh, well, it's okay, we'll figure it out. And that's kind of normal. Again, it's an emotional business we're all in, right? Everything to do with making decisions is emotional at the end of the day, at least partly. And so we just need for that to wipe out over the next 6 to 12 months. And then rationality will feed in, and that's wonderful. Not every company should make it. There's no problem with that. We should embrace failure. It's not a bad thing. Failure means we tried, we recognized that it didn't work, and we moved on to the next thing. That's healthy, and I think that hasn't happened yet.
I think one of the issues in Europe, there are so few successful companies that make it to that point. And then there's the question of if they're able to stand on their own feet as a public company, do they list in the U.S.? Do they list in Europe? Slightly before that stage, is there late stage growth funding to back those companies? So I was curious to ask this panel as well. Should there be more of a push to keep later stage companies in Europe, and if so, what needs to happen for that to materialize?
Well, this is the big question of technology sovereignty, which all of a sudden has become an iconic issue for this decade. And one's got to be very careful to distinguish between not wanting to have a globalized industry, which clearly would be a bad decision. It is good that there is the option of selling companies to the Americans and maybe sometimes to the Chinese, as long as there is a reciprocal arrangement that European companies also buy American companies, because as Tom already hinted at, Darwin was right. You've got to let evolution work on a global scale. However, there is this issue of dependencies. So when technology sovereignty becomes an issue, is if a country becomes dependent on a critical technology. By critical technology, I mean a technology that's necessary for a government to run its country properly and for economy in a country to work properly. These critical technologies, for example, are the semiconductor technology. That Trump managed to use the American dominance in silicon design software with Synopsys and Kainz. Synopsys and Kainz have a 90% market share in silicon design software worldwide. He managed to use this in a sort of extraterritorial power that he has by turning this monopoly into a weapon, this technology into a weapon to force other countries, including Britain, to do what he wants. Now, these dependencies, are as severe now as military occupation was in the past, and we just have to find our own independent access to critical technologies. So every nation now has to ask itself 3 questions. Question number 1, do I have all the critical technologies that I need to run a country and its economy? Do I have it myself? In which case, we're fine. And of course, the answer for Britain, for example, has to be absolutely no. There's no chance in hell that Britain could ever become technologically sovereign. The second question is, do I have access to these technologies from multiple independent countries so that there isn't a single country that can coerce me to do things that I don't want to do? If the answer to the second question is no, you've got to ask the third question. Do I have unfettered, long-term, longer than 5 years, access to monopoly or oligopoly, typically from the US or China? And if the answer to all 3 questions is no, then we have to do whatever it takes until you get at least 1 yes. Because if not, you accept this dependency on another country, which in my opinion is just as severe as military occupation in the past. So there will only be 3 technology sovereignty circles in the world, the US, China, and Europe. And I very much hope that despite Brexit, of course, Britain will side with Europe and help together with Europe to build the third option that we have in the world.
I just add to that, by the way, it's really interesting to think about that sort of deep tech side of things, as you always do, Hermann. But there's also a point about sort of economic sovereignty, which is if Europe keeps seeding its best graduates or its best ideas to other parts of the world, and think about the number of French and Italian and Irish and Germans working in Silicon Valley. It's a huge number, right? And we know that 50% plus of sort of entrepreneurs in the Valley in Silicon Valley are immigrants. If Europe, and indeed India, Southeast Asia, Latin America, et cetera, keep seeding the best kind of company builders to the US and to the US capital markets, not only do we have to worry about sort of our technological sovereignty, but also our economic sovereignty. The fact is, from where I sit, which is obviously a very small part of the sort of the capital markets, Europe has ceded its capital markets to the US. Completely ceded it. Our companies in Europe, our public companies that we hold in Europe, on average trade between 1% and 2% of the average daily turnover of our US comparables. That's adjusted for market cap. There's no trading of our companies in Europe. We have a couple of 2, 3, 4, 5, and they were at one stage $10 billion market cap companies here in Europe that trade anywhere between 500,000 and 2 million, not shares, but euros and pounds equivalent per day. I hold stakes in some of these companies of 500 million, a billion. I mean, the math just doesn't make any sense. How can I, as a fiduciary for my limited partners, encourage my companies to go public in a capital markets that just basically doesn't work? It's more complicated on the regulatory side, it's longer-winded, there's no research coverage, and then when you finally do go public, there's nobody trades your shares. Or we could take a 6-hour flight to New York, be warmly embraced, and indeed encouraged, made very easy to go public, huge research coverage, not always very sensible research coverage, but huge research coverage, and average daily trading volumes that are multiples of what we see in Europe. So if we think about technological sovereignty, very, very good point that Hermann's making. I'd also just say Europe is in very big jeopardy of becoming economically and capital markets-wise dependent on the US capital markets. And by the way, from what I can see in the debt capital markets, it's exactly the same thing. You look at what's happening in options and derivatives, the same thing. I mean, think about the great option derivatives houses of the last 20 years, SocGen, et cetera. They're not in that market really anymore at all. All those derivatives being created, FX, inflation, interest rate, they're all being driven by US capital markets houses. And so where I look at today is a technological problem, but also a ginormous economic problem. And more and more regulation is not going to help us get out of this. We need to figure out, first of all, how do we have a healthy, functioning capital markets? Because that's the core of all economies, and it does not function in Europe today.
Well, thanks very much. I'm sure we could talk much longer about this, but for the sake of all the panels after us, I think unfortunately we have to wrap up. But thank you for a great conversation, and thanks as well to all for the questions and the following.